Hi, I'm Louisa, Director of Aardvark Accounting, and here's everything you need to know before the end of the tax year. So let's start with what the tax year is. So the tax year runs from the 6th of April to the 5th of April every single year. It's the period in which your income is assessed for income tax, and you're then taxed on that accordingly. Making sure that you've utilised things like your personal allowance, your ISA allowances, and also pensions are really key when we look at the tax year. It's also really key to also think about what might happen in future tax years and whether it's worth actually utilising any of those allowances early or taking any further additional income now, because actually you might have income from other sources in later years as well. As we approach the end of the tax year, it's a really good time for us to get our ducks in a row. The most asked question has to always be, can I take more dividends? And the answer most times is yes, of course you can. But what we need to consider, first of all, is does the company even have enough profits for you to pay more dividends? And if you do take more dividends, is it tax efficient to do so? Or what might be the tax implications for paying out that dividends? Another thing to consider when you are paying out dividends is not all the money in the bank account is yours. You do always need to consider that corporation tax will need to be paid first, and any money left after is normally available then for the shareholders. If you don't take all of the profits, again, it's not always a negative because the profits will just be carried forward to the following year. So when we consider the end of the tax year, mostly that always relates to you as an individual. But on the odd occasion, there are a few things that would impact your company as well. So one of the things to consider is, for example, have you taken your trivial benefits? Because those are aligned with the tax year. Other than that, most other expenses will be aligned with your company year end. So unless your company year end aligns with the end of the tax year as well, you don't need to worry, you can continue to claim expenses as normal. As you know, any expenses will then reduce the profits in the company and in turn reduce the corporation tax as well. You need to make sure that for all expenses that you're claiming that you do keep the receipts, because if you don't, then HMRC can penalise you up to £3,000, and you do need to make sure that you keep those receipts for at least 6 years after the company year end. When it comes to dividends, you need to just take into account that dividends now are mainly all taxed. There is still a small allowance of tax-free dividends, which is reduced from 1,000 to 500 from April 24 onwards. But thereafter, the taxes due on the dividends remain the same as beforehand. But just as a reminder, the taxes are 8.75% for any dividends in the basic rate band, 33.75% for any dividends in the higher rate band, and 39.35% for any dividends in the additional rate band. Normally, for those clients that use the personal allowance and offset that against multiple sources of income, which could be employment income or rental or pensions, and then use the rest of the basic rate band with dividends, you'd be looking at a tax bill of around £3,255 for the year. But one of the things that always stings our clients, and you need to consider, is that if you have a tax bill of more than £1,000, and that's not all taxed at source, that HMRC will ask for payments on account. This means that you'll need to pay an extra 50% of your tax liability in addition to the other tax you'll pay as your balancing payment, and you'll make that 50% advance payment in January, but you'll also make the other 50% payment in July. As the tax year ends, we'll start to now focus on P11Ds and also the self-assessments for the 24-25 tax year. So you'll just need to keep an eye out for our questionnaires as and when they come to you. But if you complete those questionnaires quickly, we'll be able to come back and send you across the draft figures so you can understand your tax liabilities and make sure then that you've got the funds to make the payments. The current ISA allowance for this tax year is £20,000. What you need to note is that any interest from your ISA is exempt, so we don't need to include it on your tax return. The ISA allowance is also per individual, so the same applies to your spouse. However, the same allowances don't apply to children, so you'll just need to bear in mind that the junior ISA allowance for this year is £9,000. Another thing to bear in mind is that contributions into your ISA should be made personally and not from your company. Plus, if you don't use the full allowance in the current year, any unused allowances won't be carried forward. So if you don't use it, you will lose it. Pension contributions. They can work in two different ways. Either you can make individual contributions, which are employee contributions, or your company can make contributions, which would be employer contributions. Now, as an individual, if you make employee contributions, you'll get the tax relief through your self-assessment. This helps with reducing your overall taxable income for the year. If your company makes employer contributions, this is treated the same as like any other expense and will help reduce down your company profits for the year, and in turn reduce down your corporation tax liability as well. If you do contributions through your company, it tends to also have a little bit more flexibility, because not only can you have contributions, but you can also explore having contributions for your spouse, but also any other employees that you may have. The maximum that you can put into your pension this year for both employer and employee contributions is $60,000. But if you did want to do more, there are some options with the carry forward allowances, which could mean that you could maximise your pension fund this year for up to £200,000. However, before you do that, I definitely check in with a financial advisor first, just to make sure how much of your allowances you can use. There are some other things to consider as the tax year draws to a close. In regards to pensions, you always need to consider that the pension contribution needs to be made before the end of the company year in order to get the corporation tax relief. Also, any contributions that you make through your company into your pension would save you having to take the income personally, which means then you wouldn't have to pay tax on taking dividends from the business first. There are also a number of other allowances that you might want to consider, or other investments for the tax year. These could be things like EIS, SEIS or VCTs, which are all tax reducers. You'll need to consider child benefit limits. So if your income is somewhere between 60 to 80,000, HMRC will reclaw any child benefit that you've claimed. And if your income goes over 80,000, they'll look to reclaw the full value through your self-assessment. There may also be some other tax planning opportunities in regards to your spouse or other family members who are also employees or shareholders, so utilising their allowances. There's also things to consider in terms of if your income is over 100,000, you'll start to reduce your personal allowance, and therefore, should you make pension contributions to reduce the adjusted net pay. You've also got your capital gains exemption for this year, which is £3,000. And there are other allowances such as marriage allowance, so if your spouse is not using their full personal allowance, could some of it be transferred to you?